Welcome. In this lecture, we're talking about value creation and economic value added, or EVA. EVA fundamentally reshaped how we define business success. Instead of focusing on accounting profits, it asked the deeper question, are we truly creating value for our investors beyond the cost of the capital they provide? Throughout this session, we'll connect finance theory, concepts from Modigliani and Miller, Joel Stern, and others with real-world practice used by companies like Coca-Cola, SAB Miller, and Godrej. By the end, you'll see how EVA bridges the gap between academic finance and executive decision-making, and how it directly ties to your Buffett case Excel model, where you'll calculate ROIC, WACC, and EVA yourself. Remember, in business, your numbers tell a story, not just about earnings, but about how effectively a company creates value. So here's what we're aiming for in this lecture. By the end, you should be able to understand EVA's theoretical roots. In other words, how it evolved from traditional finance models. Connect those theories to practical business decisions. Apply EVA concepts in your case analysis, especially in the Buffett Excel template. Evaluate whether a company is truly creating value or just generating accounting profits. The real learning goal here isn't memorizing formulas, it's developing the mindset of a financial strategist. When you can think like an owner, you start making decisions that build sustainable value. EVA didn't appear out of thin air. It's the product of decades of financial innovation. So let's start way back in 1958, when Modigliani and Miller changed corporate finance forever. They showed that firm value comes from investment returns, not from manipulating debt, dividends, or stock structure. That insight became the foundation of value-based finance. Then, in 1970s, Joel Stern, while he was at Chase Manhattan, saw an opportunity to bring these ideas to life. He began helping CEOs analyze free cash flow, showing them that accounting profits can be misleading without accounting for capital cost. By the 1980s, Stern and Stewart launched EVA, a performance system that measures economic profit after all costs, including the cost of equity. And finally, by the 1990s and 2000s, EVA went global. Companies like Coca-Cola used it to justify selling low-return divisions. SAB Miller used it to improve capital allocation. And Godrej Industries used it to transform management culture. EVA became the language of value creation, not just a formula, but a financial philosophy. So why did we need EVA in the first place? Well, because traditional metrics, EPS, ROI, and accounting profit, tell only part of the story. So take EPS, earnings per share. It looks impressive, but it completely ignores the cost of equity. A company can grow EPS while actually destroying shareholder value if it's investing in low return projects. ROI and ROE are similar. They measure efficiency, but they can punish managers for investing in new opportunities that might temporarily reduce ratios, even if those investments create long-term value. An accounting profit? It can easily hide problems. A company might look profitable, but still destroy value if its returns don't exceed the cost of capital. As Joel Stern famously said, what gets measured gets managed, but often the wrong thing. That's why EVA focuses on the right thing, economic profit, after accounting for every cost, including investor expectations. I'm going to say that again. That's why EVA focuses on the right thing, economic profit, after accounting for every cost, including investor expectations. So what you see here in this formula is the heart of it. And this is the formula that makes the EVA so powerful. And I want to unpack that for a minute. So NOPAT, that means net operating profit after taxes, represents true operating performance before financing decisions. The WACC, you may remember from early accounting classes, weighted average cost of capital, WACC, reflects the company's blended cost of financing, both debt and equity. And invested capital is the amount of capital shareholders and lenders have put into the company. So here's the logic, and it's pretty simple but profound. If EVA is greater than 0, the firm creates value. If EVA equals 0, the firm meets expectations. And if EVA is less than 0, the firm destroys value. Now, think about the Buffett case model, for example. If Berkshire earns $35 billion in NOPAT, has $400 billion of invested capital, and a 7% WACC, the EVA is 35 minus 0.07 times 400, and that equals $7 billion of value created. That's $7 billion above what investors required for that level of risk. This is how you know whether a firm is truly earning its keep. So you're probably beginning to see that EVA just isn't a finance tool, it's a management system. It directly ties executive pay, decision-making, and accountability to value creation. Stern introduced the bonus bank, a deferred compensation system that rewards sustainable improvements in EVA rather than one-year spikes. Here's how it works. Managers build EVA improvements into a, quote, bonus bank. Bonuses are released only when the improvements are sustained over time. And if EVA drops, part of the bank is clawed back, so short-term manipulation doesn't pay off. Here's an example. Coca-Cola used EVA to evaluate which divisions were truly adding value. And so that's how they decided to divest Columbia Pictures and focus on beverages. SAB Miller implemented EVA across its breweries worldwide, driving consistent performance. And Godrich Industries saw a 60x increase in market value after adopting EVA in 2001. When incentives are based on economic value, managers behave like owners, and that's when real performance happens. One of Stern's most important insights was that EVA is as much about people as it is about numbers. When employees at all levels understand how their actions influence EVA, they begin to think differently. They stop asking, "What's my task?" and they start asking, "How can I create value?" So take Whole Foods Market. After EVA training, employees began walking customers to products instead of just pointing. That small change built loyalty, repeat purchases of customers, and measurable value. At Briggs & Stratton, the CEO said everyone started thinking about maximizing the present value of the company, not just hitting those short-term targets. That's what Stern meant by creating value change agents. When measurement systems change, behavior follows. EVA makes employees act like owners, building sustainable value across the organization. EVA works because it fixes the flaws in traditional accounting. So let's look at why. First, it accounts for all capital. EVA includes the cost of equity, the one cost most accounting systems ignore. It prevents gaming. The bonus bank system discourages short-term manipulation. And it encourages investment. Managers are rewarded for taking any project with a positive EVA, even if it lowers ROI, solving the, quote, underinvestment problem. Also, it links strategy to finance. Every strategic decision can be tested against EVA. Will it increase NOPAT? Will it reduce WACC? Will it optimize capital use? EVA, in short, creates financial discipline without discouraging growth. It keeps everyone focused on sustainable, measurable value creation. Now, I put a lot on this slide, but I also want to talk about the EVA value drivers. Managers can improve EVA by pulling 3 key levers. 1, they can increase NOPAT, drive operational efficiency and profitability. 2, they can reduce invested capital, optimize assets and working capital. Or 3, lower WACC, strengthen capital structure and manage risk. So for example, improving working capital turnover reduces invested capital, directly raising the EVA. Or refinancing expensive debt can lower WACC, increasing value creation. And so when management teams use strategy through these levers, EVA becomes not just a financial tool, but a strategic roadmap. Here's where everything ties together. Your Buffett model already includes the metrics you need, the ROIC, WACC, and EVA. Here's the process that you will follow. First, you'll calculate ROIC, NOPAT divided by investment capital. Then you're going to estimate your WACC, your cost of capital, and then you're going to compare them. This gives you your value creation spread. You multiply that spread by the invested capital, and you get EVA in terms of dollars. Then you track EVA over time, and that sustained improvement is that truest test of performance. And so as you complete your case, ask yourself, does Berkshire consistently earn above its WACC? What is driving its EVA? Efficiency, capital discipline, or strategic focus? These insights are what separate strong analysis from surface level observation. So let's wrap up with the big picture here. EVA bridges theory and practice. It takes academic finance and turns it into practical strategy. True value creation means earning more than your cost of capital. Aligned interests, EVA ensures managers, shareholders, and employees all pursue the same economic goal. And long-term focus, EVA discourages quick wins and builds sustainable performance. If you remember one line, remember this. EVA tells us whether we're creating value and not just earning income. Keep this in mind as you work on your case and watch how ROIC compares to the WACC. And this is, again, the heartbeat of value creation.